Let's get more on the future of Nike with Simeon Siegel of BMO Capital Markets. Simeon, great to have you with us. What's your take here? Does your view on the story change a lot?
Hey, guys. No, well, I think Sarah said it perfectly, and I'm sorry that I'm not Sam Poser. I know she was looking for his opinion on the from the analyst side, but I think that she brings up a lot of really good points. Like, I think that there was these words pivoting, but it's pivoting back. And so this is one of those, like, as a sell-side analyst, there's so many fun potential titles to use here, but Back to the Future feels very appropriate. And so if half the conversation is about product and half the conversation is about channel and half the conversation is about storytelling, and there's a lot more halves, what we need to know about Nike sells product and tells the story better than anyone else. And you're talking about market share. I think it's a really important point to acknowledge. They're still enormous. I mean, this is a business that right now the stock has been knocked down and the perception has been knocked down. The revenues really have not.
Why do you believe Elliott Hill is the right guy at this point when he wasn't the right guy before Donahoe?
So it's an interesting question. It's also, unfortunately, or probably fortunately, my opinion doesn't dictate who they bring in. So that's probably good. But I think that what we saw, and Melissa, you and I have talked about this in the past, where the D2C not being all it's cracked up to be. I mean, when my team put out their report 3 years ago arguing against this blind push to D2C, the notion was, well, let's common sense. Let's get rid of the middle person. We'll make a lot of money. And what we realized is, those partnerships matter. And if you do them well, they're actually incredibly economic. And I think someone who understands that, someone who tomorrow is a culture booster, right? I think there's been morale questions. I think having someone who knows this business, who's been around this business, who understands all of that product, I think right now we want to go back. It's an interesting juxtaposition. So I think the last time we spoke, you and I spoke, it was right after the Starbucks announcement. And so everyone was running these parallels of, you got to bring in someone new and someone who's going to know the general category, but will really have a brand new perspective. And I think what Nike needed was actually the change was the problem. If we go back 3-4 years, like what they were doing, it really works because it's very hard to compete with Nike's size and scale, given their R&D budget and their marketing budgets are just so large.
Simeon, you bring up a really important point when you first started, talking to us. If they're not ceding any market share, then what is it, a perception versus reality thing? Because Under Armour's outperforming them, Skechers is outperforming them, everyone is outperforming them. If they're not giving up share, why is the stock price suffering so much?
So, yeah, it's a great question. And it's not to say they're not giving up share, but they're not giving up the share that we think. And the reason I think is important is all of us think about the latest drops. We think about the LeBrons. We think about the Jordans. At $50 billion in revenue, by definition, the vast majority, these units are dramatically cheaper units that sell to people that are just running on the street, that are going to school, that are their kids. I mean, that is what this business has done that's so magical, that they've been able to segment this incredibly expensive product that we talk about, that we compare against the Hokas and the Ons and everyone that we're referencing now. But to be $50 billion, that just means you are selling so much more than just those products we talk about. And so I think that sometimes gets overlooked. And that's why I try to remind ourselves to go to the revenues. Listen, those revenues do need to be reset a little bit. They did take some of these incredible franchises and stretch them too far and dilute them. There's no question. And it'll take some time to get new products in that will replace them. Simeon, but this is not a business that watches revenues collapse.
Hey, but speaking of history and speaking of kind of what has changed and going back to the future, where have you been in terms of the multiple you've put on the stock? Have you contracted the multiple? Has it really just been a function of margin contraction? I mean, we can get into what have been some of the operational challenges to the business, but generally this is the #1 athletic brand in the world with, as you said, enviable scale in a sector that still has major secular tailwinds. So have you changed your multiple? I'm just kind of curious from the analyst community. What's different, or what do you do now?
It's such an excellent question and such a fair question to keep me intellectually honest, because at the end of the day, unfortunately, in this NVIDIA market, the multiples get moved around a lot faster than the earnings. I mean, look at the stock today. No one's changing their numbers today. And the stock obviously is moving. So by definition, the multiple is moving a lot. And so what I can say is what we have seen, it used to be Nike, Starbucks, Estee, and then dollar stores and some of the big box and some of the off-pricers. You had these hideouts in consumer that were viewed as consistent and safe and not volatile. As you lost a lot of those, people paid a lot more. The multiples for TJX, which is a company I absolutely love, looks nothing like the multiple that it used to, not because the growth rate accelerated, but because that consistency premium ran up. And so I think to your point, the Nike consistency premium when things were great were far outweighed the growth opportunities. but it was okay because you were paying for that safety. When you lost that safety, when the perception changed, the multiple started coming down. And what we're seeing tonight is with the earnings not changing at all yet, because it will take time, you're still seeing the willingness to spend. That scarcity value, Nike is slowly inching its way out of the penalty box and back into that premium sector.
So is it expensive? I mean, that's the bottom line. I mean, all that meaning, what's it mean at this point? I mean, right now it's trading 29 forward, up 10%.
It's expensive for a reason. It's expensive for a reason. I think that's what I would say. I think there's plenty of the best consumer stocks right now are incredibly expensive. And this one, as its multiple, even where we're looking high 20s, that still is cheaper than some of the other premiums you're paying for consumer companies growing less.